All right, let's jump right in. We're going to pull back the curtain on one of the most powerful, but, least understood tools in all of global finance. I'm talking about central bank swap lines. Seriously, think of it like the emergency fire hose for the entire world's financial system. So just picture this for a second. A massive global crisis hits, and suddenly, everyone on the planet needs US dollars, and they need them right now. I mean, foreign banks, big corporations, investors, they're all scrambling for dollars to pay their bills, to settle their trades. So when that demand just goes through the roof, what's stopping the whole system from just breaking, from completely seizing up? Well, the answer is actually pretty brilliant. And that answer, that thing that stops the collapse, is exactly what we're talking about today. It's this global dollar lifeline, a direct link from one central bank to another. You could call it the ultimate financial backstop. So what is a central bank swap line? Well, at its heart, it's basically a special kind of loan, but it's only between two central banks. Think of it as a formal IOU, an agreement where they say, okay, we'll exchange or swap our currencies for a little while. The whole point? To pump liquidity, in this case, US dollars, right into the system exactly when and where it's needed most, like during a full-blown panic. And how it works is surprisingly straightforward. Let's walk through it. Imagine you're a big European bank, and you are desperate for US dollars. Now, you can't just call up the US Federal Reserve yourself, but your central bank, the European Central Bank, can. So the Fed loans the ECB a bunch of dollars. In return, the ECB puts up an equivalent amount of euros as collateral. Then, down the road, they just swap back at the exact same exchange rate. It's this really clean, super low-risk way to get dollars flowing where they need to go. Now, you might be thinking this is some kind of new, fancy financial invention, but no way. This tool has been forged in crisis. Swap lines have this long, battle-tested history, and they've been fired up during pretty much every major financial meltdown of the past 60 years. And of course, how we use them has really evolved. I mean, they were first kicking around back in the 60s, mostly to keep currency stable. But their modern role? That was absolutely hammered out during the 2008 global financial crisis. The demand for dollars from banks all over the world was just insane, and the Fed had to open the floodgates like never before. Then it happened again during the Eurozone debt crisis, and you guessed it, most recently during that massive market panic when the COVID-19 pandemic first hit. And the scale of these operations, I mean, it is just staggering. Get this. At the peak of the 2008 crisis, the Fed pushed over $580 billion through these swap lines. To give you some perspective, that's more than the entire yearly economic output of a lot of countries. It was just a colossal injection of cash with one goal: stop the entire international money market from freezing solid. And look, you don't have to take my word for it. The Federal Reserve itself says these things are a proven, effective backstop for financial stability. And here's the really crucial part, why it matters right here at home. By calming down markets overseas, the Fed is also protecting the U.S. economy from the ripple effects from the blowback of a complete global financial meltdown. Okay, so we get why they exist now, but let's follow the money. How does a dollar that's basically created by the Fed in Washington, D.C., actually end up in the hands of a business in, Tokyo? Well, the whole flow is really structured, very deliberate. The Fed doesn't just start lending to thousands of individual foreign banks. That would be chaos. Instead, it deals only with its direct counterpart, like the European Central Bank or the Bank of Japan. That central bank then holds an auction to get the dollars to the commercial banks in its own country. And from there, those banks are the ones who finally lend the dollars out to businesses that need them for things like trade and investment. It's like a waterfall of liquidity, flowing from the top down. And honestly, this is where the design is just so smart. The Fed is basically shielded from the two biggest risks you could imagine. First, there's zero foreign exchange risk because the rate they swap back at is locked in from day one. And second, there's no direct credit risk. The Fed isn't worried about some random bank in another country defaulting. Why? Because its deal is only with another major, trusted central bank. That bank takes on the local risk since, it knows its own backyard best. So, for decades, this whole system was all about the US dollar and the Fed. They were the center of this financial universe. But lately, the ground has started to shift. A new, very big player has been quietly building a parallel system of its own. And I'm talking, of course, about the People's Bank of China, the PBOC. Over the last 10 years or so, China has been methodically building out its own massive network of swap lines all across the globe. What they're doing is effectively creating a parallel system. It's like a second pillar being added to the global financial safety net. But here's the thing. These two systems operate very differently. The Fed's network, it's all about pumping US dollar liquidity to mostly advanced economies to stop a market panic in its tracks. China's network, on the other hand, is mainly with developing nations, and it uses its own currency, the renminbi. And this is the crucial difference. Its goal isn't always just short-term stability. A lot of the time, it's providing longer-term support, which starts to look a whole lot more like a bailout loan to a country that's in real trouble. And after 2013, the growth was just explosive. All of a sudden, new swap agreements using the Chinese renminbi became the most common type being signed anywhere in the world. This wasn't an accident. It signals a very clear strategic push by China to expand its financial footprint and get more countries using its currency. So what does this all mean? The big takeaway is that we're seeing this multi-tiered system emerge. Think of it like this. At the very top, you've got the in crowd of advanced economies with basically unlimited access to the US dollar fire hose. But if you're in that second or third tier, maybe relying on a different network or with no access at all, well, that has real consequences. We're talking higher borrowing costs, more brutal economic crises, just less stability overall. It's creating a very clear pecking order in the global financial system. Who gets first-class access to emergency cash, and who gets left scrambling. Okay, let's pull all these threads together. What does this all mean for the future? And what should you, as an investor, or even just someone who follows the world economy, be thinking about? All right, if you remember nothing else, remember these three things. First, swap lines are the critical, invisible plumbing that keeps our dollar-based global economy from falling apart during a crisis. Second, they work so well because they're a simple, low-risk way to kill a panic and get dollars moving. And third, and this is the big one, the system isn't just about the Fed anymore. China's new parallel network is fundamentally changing the game, leading us into a much more complex, multipolar financial world. And that leaves us with a really fascinating and, frankly, a critical question for the future. For more than half a century, when you asked who is the world's lender of last resort, the answer was simple: the U.S. Federal Reserve. No question. But as this new financial architecture takes shape, the next time a truly global crisis hits, who's actually going to be holding the firehouse? This is not financial advice.